Mr. Spencer, can I get a thumbs up? Everything good? You hear me, see me? Sorry about the seeing me part, but hopefully you can hear me.
I was about to say, sorry about the seeing part, but we're good to
I
go.
can't hear you. Maybe I need to turn my audio on. There we go.
There you go. You're good to go.
Right on,
Looking
brother.
good.
All right, thanks everybody. So hi, my name is Scott Forehand. I'm an agency director here at Symmetry Financial Group with Quility. And we're here today to talk about debt-free life and the debt-free life program, which is a proprietary offering from Symmetry Financial Group, started in May of 2019. And we are on a mission, if you will, to eliminate $1 trillion of consumer debt and interest here in the United States. So let's go ahead and get rolling. I'm gonna run kind of fast today. So if this is the first time you've seen this, great. We're gonna just try to keep up. I am gonna try. I had a request to go through the advanced distribution strategies that we talk about. So I'm going to try to get to those at the end of this. So we'll just kind of run through real quick. So here's the basic debt-free life presentation that I typically do. So debt-free life. Oop, I got taller. There we go. Now I got shorter. Sorry, guys. Okay. So debt-free life. What is debt-free life? Debt-free life is a proprietary program offered by Symmetry Financial Group, which is part of Quility. And we are the focus of the debt-free life program. It depends on why we're using it, but primarily it's used to eliminate consumer debt, increase savings that we have for retirement, and create a tax-free retirement nest egg that the IRS can't touch, can't tax, and can't control. So moving forward, let's just go through this quickly. So when we're taught about the debt-free life program as broker underwriters, we're taught to ask these two primary questions. Are you 100% certain that you're going to have a great retirement? And if I could show you how to get out of debt in 9 years or less, including your mortgage, without spending any more money than you're spending right now, would you want to be told how that happens? And of course, the answers to both of these questions, of course, everybody's got doubts. And of course, everybody'd like to get out of debt, including their 30-year mortgage or 20-year mortgage in 9 years or less. I can tell you from personal experience, this program works like a charm. I can also tell you from personal experience, after running probably 1,000 or so illustrations at this point, that there's very few people that this program doesn't do what it's supposed to do. And really, the truth is, the only people I find this program won't work for are those people that should be declaring bankruptcy. And if that's their only way out. So our goal is to try to help you avoid that. So moving on. So if you're like most Americans, this represents you. You are taught from a very early age it's okay to take on debt, and you take on more and more debt as you make more money in life and go through life. You make more money and you take on more debt and more debt and more debt. And eventually all those creditors love you for it because you're making them very wealthy, because you're sacrificing your financial future so that you can have stuff at that time. So what we do here at Symmetry and Quility using the Debt-Free Life program is we find ways to put you in a position to spend your money more efficiently. Right now, what you spend right now, 40% of every dollar you make is being paid to taxes. If there's a way that we can show you how to eliminate 25% of those taxes, would you want to listen? That's probably why you're here. If we could show you how to take your interest that you're going to pay, 34% of every dollar you make is paid towards interest, consumer interest, debt, interest on your debts. If we could show you a way to eliminate that by about 40%, would you want to be here? Would you want to listen? That's why you're here. If we could show you a way to increase your cash flow from 23% to a much larger number, probably 30, 35%, then without you spending any more money, wouldn't you want to listen? And then finally, where you are, which is where I was 2.5 years ago, about 3% of my money was going into my 401k. And then I realized, did the math, ran the numbers, compared side by side a 401, my 401 versus a DFL program for my family. It's a no-brainer. There's no way in the world a 401k is going to outperform this program. Certainly, nobody who's going to recommend a 401k program is going to be able to say what I'm getting ready to say. I guarantee you won't lose money. I guarantee you'll make money. And nobody can do that with a 401. So let's move on. So the American dream, is this the American dream to make a lot of money? Well, the average American makes about $2 million. That's a lot of money. The problem with what we do as Americans, and this is because we're taught early on, like I said before, to take on debt, is that we don't save enough money for our retirement. Most Americans retire with, as that previous slide showed, about 3%. Most Americans retire with about 3% of their income saved. And if you've been spending 97% of your income for your life, thus to that point, to live on, pay your bills, pay your mortgage, put your gas in your car, put food on the table. If you've been spending 97% of your income to do all that, plus pay the interest and the taxes, and then all of a sudden you're reduced to 3%, how long is it going to last? And that's the biggest concern for most Americans these days when they're getting close to retirement, is their biggest concern is, are they going to outlive their retirement savings? And we're going to fix that. That's what Debt-Free Life does. It fixes that. Well, and most of the time when I'm talking to people, if they have debts, at some point it would have come up to them that maybe they should talk to a debt counselor or a credit counselor or somebody who professes themselves to be an expert at eliminating debt. And those counselors are going to give you a combination of those 6 bullets as a roadmap to get you out of debt. And the problem with those 6 bullets is that only one of them works. Work harder. How long can you work harder? You've been working hard your whole life. Spend less money. Okay, great. I'm going to spend less money. How's that? How long is that going to go? Save more money. How can I save more money if I'm not making more money? Refinance. Okay, so change one debt to a different debt. Consolidate. Okay, so I'm going to take all my little debts and make one bigger debt. What have I done? I haven't done anything. The only one of those that works with regularity is a debt snowball. And we're going to talk about that, but we're talking about true debt snowballing, not debt stacking, which is what most people consider to be debt snowballing. Let's move on. Better way. Again, we're back to that question. If I could show you a way to get out of debt in 9 years or less without spending any more money than you're already spending right now, wouldn't you want to listen? Wouldn't you want to know how? How many of you are throwing the flag right now? So there's no way. How can and I'm not making any more money. I'm not bringing any more money in. I'm still spending the same amount of money. How am I going to eliminate the debt that I have faster than the track that I'm on right now? That's because our system uses 2 critical financial concepts: concept of infinite banking and the concept of a true debt snowball. Either one is powerful by itself, but when you put the 2 of them in combination and then use a feature that's in the IRS tax code that allows us to really, really hypersize this program without having taxation, then you've got a juggernaut that can't be stopped. That's what a debt-free life program is. So what are we going to do? We're going to move you from the left side of your screen to the right side of your screen. We're going to take you from spending 23% of the money that you make on lifestyle. That's your cash flow. That's paying your bills, putting food on the table, paying your Netflix bill, paying your Hulu bill, paying your cell phone bill, going out to eat, going to the movies, catching a game, going to a concert. That's the lifestyle money. We're going to change it from 23% of your dollars to 33% of your dollars, because we know that if a program is too painful, you're not going to stick with it. So the program has to be something that you're comfortable with. We're going to change the amount of taxes you pay over time by 40% down to 30%. Simple math says that's a 10% reduction. True math says that's actually a 25% reduction in what you're going to pay over taxes over time. That's huge. We're going to change from 34%, and I can't see it because my screen is blocking it. We're going to change from 34% down to 22% of your money to pay consumer debt interest. That is a huge number. Simple math would say that's a 12% reduction. Nope. That's almost a 40% reduction. And then finally, and this is the critical thing, this is why this program works, because we're going to set your retirement up a way that you've never been taught to set your retirement up. And more importantly, this is a critical thing when I compare these programs to 401ks, traditional 401ks, managed funds, 403s, KIOs, SEPs, all those traditional retirement programs, which now, because of the way that our country is sitting with the debt that we're in, all those programs are starting to not look so rosy as they were before. And that's simply because the interest rate that they're paying out is reduced. the fees that they're charged to manage those funds are not reduced, and you're losing a significant percentage. So you're looking at an average return on some of those programs. What I'm seeing is less than 3% at this point. And our program starts at 4%. No brainer. Those programs grow taxed. Our program grows non-tax. Simple. Moving on. All right. Sorry. So what we're trying to do is we're trying to get you to that pie chart on the right side of your screen. We're going to increase the amount you spend for savings. We're going to increase the amount of money you save for retirement by 500%. We're going to decrease the amount of money you pay for taxes by 25%. We're going to decrease the amount you spend for interest by 40%. And we're going to increase the amount of money you have for lifestyle by 43%. So let's look at this for a minute. Let's say at the end of the month right now, in your current situation, you have $1,000 left over. It's a lot of money. What happens if I can make that $1,400? Over the course of a year, that means I'm putting an additional $5,000 of money into your pocket. You can do whatever you want to do with. If you're smart, you'll actually roll it right back into the program and capture it forever. If you want to have fun now, then you're going to go out and buy a new jet ski. Whatever. It's your money. Do what you want to do with it. But the point is that the program is going to allow you to have those options, be able to make those decisions. And how do we do it? Those are the bullet points on the left. And remember how I said the previous methodologies would show you 6 bullet points, of which only 1 worked? Well, the bullet points that we're showing you on the left all work. We're going to reduce the amount of interest you pay over time. How? We're going to pay stuff off faster than you planned, faster than you have a concept to do. We're going to eliminate all your debt in 9 years or less. Really, what I'm finding is that's not a true statement. It's not 9 years less. It's actually 15 to 27 years early is what I'd like to say. We're going to reduce the amount you spend on taxes over time. How much? Significantly. Where's that money? You were going to pay that money anyway. Where's it going? It's going right back into your pocket, Jamal and Spencer. We're going to improve your cash flow over time. We're going to save you some money. And we're going to allow you to retire with a tax-favored income. Let me ask you this. If you had taxed, tax-favored, or tax-exempt, which income would you rather retire with? And for me, the most tax-favored income of all is the tax-exempt income, according to Desario. So, moving on. There's programs that have been around for a long time. This is not anything new. The concept of infinite banking has been around in one form or another for over 100 years. The concept of debt snowballing has been around for at least 40 or 50 years. The problem with what came before us is they were all built on faulty premises. One program that's very popular that's out there uses a home equity line of credit as a funding source or a funding strategy. Let me ask you this. Why would you transfer credit card debt, which has absolutely no claim whatsoever, to the equity in your home and trade equity in your home to eliminate that credit card debt? Why would you do that? It's silly. Why in the world would you say, okay, I've got $20,000 in debt that I can pay off a little piece at a time every 2 months, every 4 months? Why would you do that and trade it in for one loan that's going to take you 3.5 years to pay off? Why would you do that? So these are all programs these are reasons why programs have failed in the past. But there's one common thread. There's one common reason why all the programs before what we've got here has failed. And that's because it didn't plan for the unexpected. It didn't plan for someone losing their job. It didn't plan for someone becoming sick and becoming unable to work. It didn't plan for someone dying early. All those programs before used some other kind of debt. And the debt didn't go away when you pass. Our program's different. We prepare for that unexpected, not only because we're using life insurance as the vehicle. So if you die, it's paying everything off. What happens if you don't die? Living benefits, folks. Yep, you're still getting to get access to your death benefit. Okay. What happens if I don't die? I don't have those problems, but all of a sudden, my mother ends up needing support and she's getting ready to lose her home. Okay. Well, that's a true emergency. And so what I'm telling you here is that the solution that we have in place takes into consideration those other contingencies that the other companies, the other programs have missed in the past. And we go a step further. We looked at what the most common reason why all those programs, there's at least 10 of them that I know of, why all those programs fail in the past, and it's because they don't plan for that emergency. Our system by default has an emergency fund that's hidden. It's there. You can get to the money if you really need to, but we want to make it painful for you if you do. You don't want to touch the money. This is not, I need to take that emergency trip to Tahiti, Brett Desario. This is not, I need that emergency jet ski, Martin Rice. This is, I have a real emergency. I need to get to that money. It's a true emergency. Okay, now you can get to it. So this is that situation where we're going to make the funds available to you in a true emergency. It's going to be painful to do it. You're not going to want to do it. You're going to want to try to figure out plan B and plan C before you go to this. So I asked you a question a few minutes ago. If you had an option to choose a taxed retirement program, a tax deferred retirement program, which that tax deferred should have brackets around it. It's not really tax deferred. That word deferred should actually be tax grown retirement income, because what you're doing in a tax deferred program is you're growing the taxes that you owe over time, and the federal government thanks you. And then finally, a tax-free program, a true tax-free program, which is what debt-free life is. The numbers that you see on the screen in front of you, this is not magic. It's just math. We use the same investment strategy. $10,000 is the amount, 28 years is the investment time frame, an average 7% interest return over time, and a 25% tax rate when you pull the money out. That tax rate's low, everybody. If you think that you're gonna have a 25% tax rate when you retire, guess again. The federal government's spending money hand over fist like it's going out of style, and I would be surprised if your tax rate's going to be lower than 30% by the time you're able to touch it, unless you're real close to retirement. So those numbers are the same. It doesn't matter. But the bottom line is that simple little tax problem when you have that tax deferred money going to that 401 or 403 or KEO or SEP or TSP or whatever you're using, that the tax obligation is growing as well. And that tax obligation is what's going to bite you in the end. So you may see 8% growth, but when you take out the 4% that's growing the taxes also, your net growth is only 4%. Congratulations. You bit into the poison apple and you drank the Kool-Aid. Unfortunately for you, you're kind of stuck until you talk to a Symmetry or a Quality agent, because we can fix that for you. Finally, this program is like all financial programs. It works in phases. All financial instruments have 3 phases of execution. There's a maximization phase, an accumulation phase, and a distribution phase. In our system, the maximization phase is when we're maximizing the amount of money that you're putting away for retirement to get you on the straight and narrow to that accumulation phase where you have reached maximum and you've got no more debt. We're eliminating your debt. In the process of eliminating that debt quickly during the maximization phase, what we're also doing is eliminating the interest you're going to pay over time. And what we're also doing is we're going to eliminate the amount of income taxes you're going to pay when you reach the distribution phase of this model, which is when you take the money out. The accumulation phase, that means your debt's gone. That means that at that point, this is going to happen. In some cases, I've seen as quick as about 2.3 years, where the debt's eliminated, and now you really get it. You understand how powerful this program is, and you are throwing every single penny you can into this program because you want it to grow faster and faster and faster. And where you thought you're going to retire at 65, holy cow, hold your socks on, because now through this program, you're retiring 7 years early with more money than you thought you were going to have at 65. That's the power of this program once you execute them properly. And finally, the distribution phase. That's when Brett Desario gets to go take that emergency trip to Tahiti. That's when Courtney can go buy that emergency jet ski. That's when Javon Spencer and Scott Forehand can go open their own food truck. That's when we get to do whatever you want to do. It's the distribution phase. Take the money, do what you want to do. It's your money. Take it, have fun. So I mentioned this program's been around for a while. There's 4 modern people that have used it that you're familiar with. Warren Buffett, certainly everybody's familiar with. Ray Kroc with McDonald's, Walt Disney. But little known, Rockefellers did this back in 1912 is when they started. The Rothschilds did this back in 1910. And guess what? They did it with one of the carriers that we used that was around back then. So this is not a new program. It's been around for a very long time. Problem is, there's a high level, a high cost of entry previously. You had to have around 7 figures to be able to start one of these programs in previous more than 20 or 30 years ago. But now You can do it with as little as $65 a month. That's the one I did last week for an 18-year-old. So anybody can do this. Pretty much everybody can afford this. The more debts, plural, you have, the better the programs work. Not the amount of debt, the more debts, plural. The amount of debts is irrelevant. Works for everybody. Moving on. Again, this is just a summary of what we've already talked about. Nothing new here. One point of interest. When you start these programs, it is okay. Life happens. It's okay to take on more debt. I had a woman that I did one of these with 2 summers ago, and about 3 months after we did her application, she ran into a situation where she had to buy a new water filtration system for her home. It was $6,000. So from the time that we did the application until the time that we actually started the program, she was $6,000 more in debt than when she started. But that $6,000 of debt, because of the nature of our program, actually caused her program to work 2.2 years faster. So she got out of debt instead of 12.4 years, she got out of debt in 10.2 years. And when she was going to be retiring, that little $6,000 of debt had grown $80,000 of additional retirement money, just to the effect of snowballing and compound interest and all those things that we do. So it's okay, take on debt. If you need a new car, go buy a new car, but don't go buy a new Maserati unless you're in that distribution phase. That was specifically for my wife. All right, moving on. So this program, like I said, we started this in 2019. Those were some of the early folks that we helped. $84,000, $100,000, $73,000. That's about normal for the amount of interest that we eliminate. As far as the amount of debt we eliminate, that's very, very light. We'll talk about that. I'm going to show you that in just a sec. So first off, let's make sure you understand how you're currently spending money. This is how you spend money. You make money, it gets deposited into your checking account. Doesn't matter who you bank with, it gets deposited into your checking account. That bank takes your money, because it is your money. They take your money and they invest it. How do they invest it? Well, actually, they lend it out every night at the federal funds rate, or they give somebody a credit card at 24% interest, or they fund a loan, or they fund a car loan, or they fund somebody's home, whatever, or a personal loan, whatever the case may be. They're taking your money and they're lending it to somebody else. Point of order. Anybody ever taken out a CD? Right. I took out a $10,000 CD. I thought I was getting a good deal. I got 2.2% interest on it. Great, for 2 years. About 2 weeks later, I needed to borrow some money. The bank was more than happy to lend me money. They were more than happy to lend me my money. They were happy to lend me my money, my $10,000 at 4.2% interest. Thank you, Mr. Bank. So that's what happens when you make somebody who knows how to do math angry, because they figure out what's going on and then they figure out how to get around it. This is how to get around it, people. Remember that money? If the bank is making money with your money every night, overnight, and then all of a sudden you tell the bank, hey, I need you to go ahead and pay my car payment. So the bank pays your debt, sends your money to the creditor. Creditor's happy, they got their money. Bank's happy, they got to use your money. You're unhappy, your money's gone. Where's your money, Brett Desario? Your money's now their money. Are you ever getting that money back? No. And if you're super sweet, super nice, and you put on your best Courtney Desario and she says, can I have my money back, please? Is it coming back? No, it's gone forever, right? That's the current method, the current way you spend money. Here's the way we do it at Debt Free Life. Same money, same income, same bank, goes into your checking account, doesn't matter who. Here's where the rubber meets the road. Instead of leaving the money in our checking account, letting our bank lend it out overnight, every night, making money with it, not giving us a dime, other than maybe they'll say, thank you very much, Mr. Forehand, for keeping your $5,000 in our bank. Because we've got so much of your money in our bank, we're not going to charge you a fee to keep your money in my bank. Okay. Piss off Mr. Forehand number 2, right? So what we're going to do is we're going to buy life insurance. We're going to buy specifically participating whole life insurance. It's a very specific name, participating whole life. The word participating means we get to participate with the profit of the insurance company. Anybody have any idea what the most profitable companies on the planet are? Insurance companies. Can anybody name an insurance company that's gone belly up? No, you can't. Can anybody name a bank that's gone belly up? Of course you can. Can anybody name an investment company, Bear Stearns, Lehman Brothers, that's gone belly up? Of course you can. Insurance companies are the largest institutional investors on the planet. They're also the most profitable companies on the planet. So you're investing and you're able to invest in the most profitable company on the planet simply by buying life insurance. Congratulations, you win, right? That's where it starts, folks. When you buy that whole life policy, you're also buying a term life rider and a paid up addition rider. What does that mean? The term life rider, what that does is that takes advantage of IRS tax code 7702A, which says all monies derived from a life insurance policy is tax exempt, as long as the amount of life insurance in that policy exceeds the amount of cash in that policy. So what that term life rider does is it increases the total amount of life insurance in our program. By increasing the total amount of life insurance, we have more room underneath to grow the cash. As we grow the cash, eventually we reach that point. But here's the trick. That's that third option, that paid up addition option. What is that? That is additional life insurance. However, the carrier, the insurance company, remember, that's paying you a dividend because you're an investor and they're paying you interest because you have a life insurance policy with them. The carrier considers your paid up additions as cash. So when they do that calculation about how much they're going to pay you on the cash that you've given them to invest, they're counting your paid up additions as an investment deposit. Now, what is it really? It's life insurance. So that means the carrier's counting it as cash. They're paying us on the cash value. The IRS sees it as life insurance. They're not counting it as cash. They're counting it as life insurance. That means our umbrella stays high. And eventually we've got enough cash in here through real cash and paid up additions. We don't need the term anymore because the paid up additions has grown up enough that we now have enough paid up additions as well as whole life that exceeds the cash value, and the IRS can go pound sand, which is something we love to tell them to do. Okay. So now we've got whole life, term life rider, paid up additions. Couple key things here. Whole life, it is one policy, it is one premium. The riders are term life and paid up additions. Okay. From the term life rider eventually goes away because we don't need it anymore because the paid up additions have built up enough cash. So let me ask you this. If you had an investment that you had to pay for one time, that didn't cost anything to maintain, that would never lose value, that would always be worth what you paid for it, what is that a good investment? So from an investor's standpoint, there's zero risk, but there's always a 0% chance of loss. Okay. So from an investor's perspective, it's a very safe, very safe conventionally form of investment. In banking terms, it's called a tier 1 investment strategy. Tier 1, 2, 3, 4, right? Tier 1, this zero cost to maintain, 0% chance it's going to lose value ever. Very safe investment. Tier 4 investment, giving a 19-year-old dishwasher $2 million to go open a restaurant because they think they know how to do it. Very risky investment, probably going to fail. Okay. So the idea here is that banks love this. Just as an aside, Wells Fargo, for example, 48% of all of their tier 1 assets are exactly this. It's life insurance that they buy. There's companies out there called viatical settlement companies whose sole job it is to go find suckers who have life insurance policies that has value, and they'll, if it's worth $100,000, they'll give them $5,000 cash and make them sign over the beneficiary to the company that's buying it. That's a viatical settlement company. They're predatory, but they're out there, and the banks use them to procure this. So Wells Fargo, 48% of their tier 1 assets are in life insurance that they've bought. Why? Because they're never going to lose value. They don't have to pay anything to maintain it. So I think I've beat that horse enough. So let's move on a little bit. So now you got your paid up additions. So now what's happened? You've moved that recycle circle, the money where the bank was lending your money out every night, overnight, over and over and over. You've moved it into your corner. You've moved it over your bank. And now you're making your bank make money with it every night. Why? Because you're getting paid interest on the money that you have in here. Depending on the carrier with, sometimes you're getting paid compounded monthly interest. Sometimes it's just annual. Again, depending on the carrier with, sometimes you're making money with a dividend that's paid back based on unencumbered money. And sometimes it doesn't matter whether the money's encumbered or not. Just depends on the carrier. So finally, Brett Desario, I've got money in my bank, and now all of a sudden my money, I need to do something with it. I have to pay my credit card. I'm going to pay my credit card off. My credit card's $1,000. What am I going to do? Am I going to stroke a check for $1,000 out of my checking account? Not yet. I'm going to tell my bank, my private bank, my DFL bank, I'm going to say, hey, Mr. Carrier, I want to take a loan against the value of my program. I don't want to take my money out. I don't want to touch my principal. I want to take a loan. So what do? You tell the carrier to give you a loan. Carrier takes some money out. Is it your money? Nope. Does it affect your guaranteed interest rate? Nope. Is it encumbering the money that you have in the program? Depending on whether or not it's a company that looks at that or recognizes that, maybe. Does that really affect everything? In the grand scheme of things, it doesn't. Not really. It'll affect the dividend in the first couple of years. The amount of dividend you're going to get on your program is going to be minimal anyway, so you're not really losing anything. So I say, hey, Mr. Carrier, put $1,000. I have to pay $1,000 on my credit card. I want to pay my credit card off. Give me $1,000. So they deposit $1,000 right back into your checking account. And your bank thinks it's going to get to make money with it. But no, you take that money and you pay your debt. The bank gets to hold on to your money for one day. Suckers. And then we move on. We tell our bank to pay the debt. The debt gets paid. My lender's happy. They've got their money, right? Brett Desario, do they have my money? No. They have the carrier's money. My money is still sitting in my DFL bank with the carrier, earning my guaranteed interest rate. The unencumbered portion is certainly earning my dividend. If I'm with a company that doesn't encumber it, then I'm still earning the full dividend. Win, win, win. The creditor got paid. They don't care where the money comes from as long as they get the money. I'm making money with my money. I didn't use my money. I used the carrier's money. No brainer, right? How's this work in practice? Here's a family I did this with back in October 2019. This is not unusual. This is both these, the mother and the father had been married previously. The woman was a student at that time. She's now a teacher. She's a professor at William & Mary. At that time, she was a doctoral student. Her husband was a truck driver previously. Now he's a truck driver that owns his own trucking company and owns 2 big rigs that he was able to pay cash for with this program, by the way. So this program, when I met them, they were this much in debt. They thought they were $584,000 in debt. Were they $584,000 in debt, Brett Desario? Nay, says Brett. How much in debt were they? They were $767,000 if you look at the amount of interest they were going to pay over time, which is $182,000. And the reason why they were going to be paying that debt for 40 years, as you see right there, is why? Javon Spencer, because the wife had a student loan. And which one was student loans? Student loans are evil, people, right? So there you go. So here's what happened to them. We took them from 40 years to get out of debt down to 7.8. Sign me up, baby, right? 40 years to 7.8. So what did that really mean? That means that we gave them 32.2 years in which to build their nest egg where they had no debt, completely debt-free. All that money and interest they're going to be saving over time, they're going to be spending over time, we're now putting right back in their pockets. All that money that we're saving for that big payoff in the end is creating a nest egg they never thought possible. Where they thought they were going to be in 40 years, debt-free, no savings, 100% equity in 2 houses. That's not bad. Those 2 houses, they could use that as retirement, right? No. This is where they are. Brett Desario, 40 years, $182,000 in interest versus 7.8 years, saving him $70,000 in interest and creating $4.8 million of liquidity. It's a lot of pennies, right? So for me, in my perspective, 40 years with 2 houses fully paid for and no savings is not as good as 40 years with 2 houses fully paid for, 100% equity, and $4.8 million in liquid assets. Oh, and wait, and $1.1 million of paid up life insurance. Okay, yeah, that's a $5.9 million total. So that's a $5.9 million swing without them making any more money than they're already making, without them spending any more money than they're already spending. Okay, so sign me up. Actually, I already did. All right, so here's how this works. So each one of those yellow bars is a year in which they paid off some debt. Okay, if you look at the first year, they paid They took a loan of $14,915 loan from CV, loan from Cash Value, $14,915 loaned from the system. That means they paid off $14,915 of the debt. Okay. But look, at the end of the year, not only did they borrow $14,900, they paid off all of it to the point where, well, they paid off most of it, but they had $12,000 plus left over liquid cash at the end of the year. That's huge. Second year is even bigger. Why? Here's a critical thing, Brett Desario. Am I ever taking my money out of the program? No, my money's in there forever. So when I don't touch my money, that means the next year I'm adding to my nest egg. It's getting bigger and bigger and bigger, right? And as it's getting bigger and bigger and bigger, the interest that I'm earning is growing and growing and growing. And the dividend that I'm getting is growing and growing and growing. That's how in the second year, I'm able to borrow $15,000 from my program, paid off everything that was owed from the previous year, paid off half of the 15 that I borrowed from this year, and still had $40,000 left over at the end of the year. Holy cow, there's your holy cow moment. Somebody ring a bell, right? So moving on, right? Ding.
Ding,
Next
ding.
year, what's happening now? Holy crap, right? $58,000 borrowed. $48,000 is what's left. So I'm not paying a lot of that $58,000 borrowed, but look, I'm paying back $10,000 of what I borrowed. And at the end of the year, I've got almost $30,000 cash left over at the end of this year. Okay. Here's where the danger happens with these programs. I've been trying to shoot holes in this ever since I first heard about it. I was certain that there's some scam, that there's some hole, that there's some loophole, that there's some way that I'm going to get screwed over if I do one of these programs. And I cannot find it except for this one thing. And I've seen it twice so far. The one thing that causes this program to fail is this: anal liquidity. If you are someone, there's a reason why professional athletes, 65% of professional athletes with $1 million+ contracts are broke within 5 years of when they stop playing. There's a reason why people, by more than 50% of the people who win the lottery, are broke within 3 years of when they win the lottery. And the reason is most people do not know how to handle large sums of money if they haven't done it before. So if you have the temptation, and this creeps into your head, Brett Desario, you know what? I work really hard. I work hard for my money. I've been doing this for a long time. I deserve a toy. I'm going to go out and buy that boat. And if you do stuff like that with this program before it's appropriate, before you've reached that distribution phase where you can buy that emergency Grady White with twin 250s and tuna tower, incidentally, that's what I want for Christmas. If you get to that point, then you're making a mistake. Okay. That's the danger. The danger is spending the money before it's supposed to be spent on stuff you shouldn't be spending it on. Looking at year four is not unusual. By year four, remember all those debts these people had? All these are debts, right? In year four, we don't pay off anything. Why? Because all the little debts, like when I say little, I mean like they had 2 cars that were $50,000 each, right? All the little debts are gone. The only thing left is the evil student loan and 2 houses. That's it, 3 more debts, right? In the year 5, which is actually 4.7, they're paying off one of the houses. In year 6, they're paying off another one of the houses. In year 7.8, they're paying off that final evil student loan. And then they're debt free. Not really. Why? Because they took a loan. Okay, I took a loan. Here's my loan. Anybody have any idea what the net interest on this loan is? 0.76%. That's your net interest. That's 4% if it's a guaranteed plus a dividend, minus the 4.7 or plus the 4.7 they charge you. The delta is 0.76%. So, Brett, if you had an option to take out a home loan for 2.75% if you get a great rate these days, or take a loan from yourself at 0.76% net cost, which one would you do? I'm going to take the loan for myself, right? Same as you, right? No brainer, right? Incidentally, this program was great for people that flip houses. Great. All right. So now let's look at what happened in year 9. In year 9, all I'm doing is making my payments, right? So let's be real. These people make a lot of money. They spend a lot of money. They've spent a lot of money. They spent a lot of money inefficiently and poorly, which is why they're in the debt situations they're in right now. But they're able to fund this program to the rate of $32,000 a year. Okay. So they paid $32,000 into the program, but they eliminated $100,000 worth of debt. How'd that happen, Brett? Compounding.
Compound interest.
Compounding. What's the other one? Come on. Starts with a D.
Dividends.
Yes. Right. Compounding and dividend plus some snowball action. Year 10, now we're completely out of debt. We're paying off $54,000 of debt and we're growing $100,000 again, right? So this guy, when we did this program, he said he wanted to retire at 75. So we did. I accomplished what he said. All right, no problem. We'll run this to age 75. At age 75, he was going to have $4.8 million liquid in the program. But I said, wait a minute. What about if we get you out of here at 55? So if you look, year 55, when he's age 55 and 56, this is a 20-year program, folks, only 20 years, right? At 55 years old, we stop. We're at $1.512 million liquid in the program. In year 56, we only paid $21,000 into the program, but we're $1.648 million. So if we take out that $21,000 that we spent from 1.648, that leaves us 1.627. That means our program grew $125,000 or $115,000 in the 1 year without me spending a dime. So if I'm to the point where I'm ready to retire at now 55, then I can go ahead and retire at 55. I'm going to retire at 55 with how much income per year? Tax exempt? $115,000 a year. Brett, sorry, I don't know about you, but if I had $115,000 a year and zero debt, if all I had to do is pay my power bill, my water bill, and food on the table, I could probably do it on $115 a year, especially if I didn't have to pay any taxes.
Going fishing on that boat, man.
Probably, yeah, there you go. Spend all the time. I'll catch my food. There you go. Right on. All right. So this is the idea, folks. This program works like a charm. It works for, I would say, probably 90% of the people, because there are 10% of the people who just have too much debt and you should probably declare bankruptcy. That doesn't mean you can't do one of these. You just have to wait 2 years to do it after your bankruptcy is taken care of. Now, normally I would show a student example. This is somebody who doesn't have any debt. Again, student loans being evil. But we've done this. If you haven't been here before, you can certainly go on and check on YouTube. There's lots of these videos that are up there, but I did want to get to some of the advanced market stuff, the different ways that you can use this in the 3 different phases: the accumulation phase, the distribution phase, and the maximization phase. So let's go ahead and start that. Anybody have any questions? I'm going to check the chat real quick. Looks like we're good to go. Okay. All right. Very good. So let me go ahead and get that part up. Mr. Spencer, I'm going to give you a topic to talk about. Why don't we talk about tea and the price of it in China? Go ahead, go.
Oh man. Next time I'm gonna use somebody else's Zoom so I could just sit back and sneak in and not ever say anything.
I know, right?
I like that, Scott. You said something, I'm about catchphrases, especially in my marketing mind. And you said, this is something the IRS can't touch, can't tax, can't control. And me and Courtney looked down at each other and had that click, like boom, like that was dope. So thank you. Got my new ads gonna be up tomorrow.
You're welcome. Oh, by the way, that's trademarked by me. Not to be used without express written permission from Ricky Bobby Inc.
I knew I would get a nugget. You want a program that the IRS can't touch, can't tax, and can't control? Call me. Only me. Thank you, Scott. That's awesome.
All right, so let's get back. So what I'm going to do now is I'm going to show you. This is a strategy to hypersize the program in the maximization phase. Okay, so this works especially well for people that have mortgages, especially well for people that have conventional mortgages or have VA mortgages where they're more than 80% or less than 80% loan to value. All right, so this is a client that I did this for last year. He had a $1,700 a month mortgage. Of that mortgage, at a 30-year mortgage, 888 was principal, 300 was, it was interest, 300 was principal, 168 were taxes, 310 were insurance. So if I'm paying, and this works the same way for a business perspective, using like taxes, for example, when you have to pay your personal income taxes. If you have a cyclical debt that's going to be coming up every month, and you're shelling out that money, it's the same car payment discussion as earlier. Once I make that premium payment, the money's gone. I'm never getting it back. But what happens if I sequester that money into my DFL program first? Okay, so here's the thing. Right now, if I pay this 168 in taxes and 310 insurance, that's $478. If I pay that 12 times, that's $5,736 a year. I'm paying to who, Brett Desario? My lender, because they're holding it in escrow for me. And what are they doing for me? They're making money with my money. And then they're paying my escrow fee, my taxes and my insurance once or twice a year, depending on where you live. So what am I doing here? I'm giving them $5,736 a year that they can make interest with, that they don't give me any of. So I don't have to write 2 checks. 2 checks. How much does it cost me to write 2 checks? Well, probably about 50 cents per check at the most. And that's if I include the cost of mailing it, maybe $1, maybe $1. So for $4 a year, to save me $4 and the expense of writing and the time to write 2 checks twice a year, I'm giving them $5,736 to invest, right? Are they giving me any of the money that they make from that investment? No. Are they reducing my cost to pay my mortgage payment? No. Is it a requirement for me to allow them to hold my escrow? On an FHA loan, yes. On a conventional loan, no. On a VA loan, only if you have less than 80% of the loan paid off. So if you're at 78% loan to value, you're good to go. Okay. So Mr. Desario, if I had a program that would say guarantee me 4% interest on that money, $5,736 a year, do you think 4% of $5,736 is $229? Look at the bottom of the page before you answer. You think that math works out? You're brilliant, Brett, brilliant, I tell you. All right. So look, so what happens if instead of me taking that $5,736 and paying my lender and letting them hold the money, this is that, that whole, you're 18 years old, you get your first job, you claim 0 on your tax return so that you can get that money back from Uncle Sam at the end of the year, and they're going to give you 0 interest, right? Same kind of concept. We're taught to do this. We're taught it's okay. It's not. We're wasting money. We're not spending money inefficiently. So if I do this and I put that money, $5,736, and I put that into my DFL program, in that first month, the interest I'm going to earn over the course of a year on that, it's going to be $229. That's $5,965. $5,736 plus $229 is $5,965. Okay. The interest is going to cost me to turn around and take that money right back out and pay my homeowners insurance and my property taxes for the year. The interest is going to cost me a net $45. Okay. So one way, I spend $4 writing 2 checks a year plus 45. So it costs me $49 to do this per year. Or I can let my lender do it for me and it costs me 0. Okay. So for the first year, I lose $49. But what did I do, Brett? I sequestered $5,965 so that when I do it in year 2, boom, now I'm in the black. I'm not earning all 229. It's getting credited to my account. It stays there, okay? But because of the cost of the loans, then I'm losing, I'm not able to capture all $229. So by doing this 2 years in a row, I've created an additional $11,893. It's in my retirement fund, Brett. $11,893. So here you go. Let's weigh it out. Okay. I'm going to let my lender pay it for me. I get zero. I'm going to do it myself with my DFL. I capture almost $12,000. It's going to be working for me for the rest of my life. Did you have a holy cow moment there, Brett? You should have. Let's blow the rest of that mind up. Here you go. You ready? And it keeps going and it keeps going. So Brett, in year 15, are my property taxes ever going to stop? No. Is my homeowners insurance ever going to stop? No. So what happens here? So if I did this program one way, I would have to, okay, that's 15 years, 2 checks a year. So that's 30 checks I'm going to have to write over 30 years. So the fee for me to not have to write 30 checks, Brett, is $119,449. I'll cut you a deal, Brett. I'll write those checks for you. I'll do it for $50,000. I'll write those checks for you every year. I'll do it for you. I do that for you. And I'm that kind of guy. All right. So the point that I'm making here is, look, you can let your money work for you, or you can work for your money. This is that old, the old adage. We've been saying this a long time. You can work hard for your money. You can let your money work hard for you. This is the latter. This is letting your money work for you. You don't have to let your mortgage company hold on to your escrows. You don't have to lose that interest. And in this scenario, because we're capturing those escrows every year, it's growing. By the way, Brett, in year 17, you've reached critical mass with this program where the interest and dividend, I didn't compute a dividend here, by the way. There's no dividend added here. This is just basic straight interest. In year 17, there's enough just interest to pay your taxes and to pay your homeowner's insurance. So now it's a completely self-funded program in 17 years. Anybody have a holy cow moment? What do you think, Spence? Any comments? Come on, man. Give me some feedback.
Just blown away. I mean, I've never even thought about that plan touching the escrow at all.
All right. Linda Chung, you still with us? Or you being silent tonight?
I'm here.
Yeah, you got any comments on this one?
No, my brain is exploding, so I have to clean up my brain.
All right. So I don't see, I see one chat comment. What's the question? Reportedly, we pay some of the high taxes and cover the insurance on these higher mortgages equals almost an old mortgage rate. How do we include this in the DFL plan? One caveat. The caveat is this. Under no circumstances can this be a primary funding strategy. All these programs I'm going to show you tonight, all these advanced concepts, these are secondary funding strategies or secondary distribution strategies. Your primary funding strategy has to be a large, if you try to do this with a DFL program that's $100 a month, it will fail, okay? Because you have to have enough interest cycling through this that you're paying off those loans with regularity. I didn't even talk about that, okay? Where are the instructions on how to illustrate this, not only for me, but for the homeowner? Well, that's a great question. And I'm working on that with Mike Resma. We have something coming out. It's going to be announced pretty soon. It's not there yet. We're working on it. All right. So let me go ahead and close this one out. And we'll go on to the next one. Anybody else have any questions before I go to the next thing? I don't see any hands. I don't see any chat. All right. All right, Spencer, pick another topic. Have at it.
Good topic that I'm co-hosting out the blue. Should I bring this up to my client? Like, I know how do you gauge when you go this in depth versus someone who's just happy on the second page of the illustration? What makes you get the warm fuzzies to go into escrow and all that versus just keeping it like 20 years?
Right. So I'm going to ask the question up front. I'm going to say, what kind of loan do you have? And that's going to be my barometer whether or not I go into this. And if the answer is I've got a VA loan or I've got a conventional loan, I'm going to say, well, depending on how we use your program, there might be another way where you can capture a lot of your escrows. Does that make sense? Are you interested in doing that? Are you interested in letting your current lender continue to make money with your money that they're escrowing for you?
Nice.
I'm always, because I feel this way, I'm always pitting, it's us against the bank or it's us against the lender, because it is. The lender's not going to do anything to help these people. You know, that's my job. All right. So let's talk about mortgage chunking. If you took the Larry training, I wouldn't call it training, the Larry sales pitch down in Florida, then you were given about 2 seconds conversation about mortgage chunking. He doesn't tell you how to do it. He doesn't understand. It doesn't explain it. So I'm going to go ahead and explain it to you and show you how we use it. All right. So this is mortgage chunking. Go on. You guys see my mortgage chunking screen? Probably not, because I haven't shared it yet. Let's share it. Here we go, mortgage chunking. So this is mortgage chunking. So this is a program. This is the same couple that I showed you earlier. Okay, this is their plan. All this is the same. Nothing's changed. 7.8 years, right? Okay. There are tweaks that you can do to a DFL program. And if you do all the tweaks, everyone's incrementally better. Okay. This is one that's incrementally better, depending on the length of term of the mortgage and the amount that they're overfunding the program. A mortgage chunking routine may be available to them. And if it is available to them, it can make the program work up to 16% faster. So in this scenario, remember these guys, 4.8 million in 40 years, right? Right? In this scenario, we're going to use their primary mortgage as the chunking mechanism, which at the time that this application was written, it was a $215,000 program. One of the questions I get, well, we look at the sweet spot for people to enter this program. There's a specific number of debts that really make the programs fly. And there's some other things that we look at: disposable income, currently overpaying on certain debts. Those kinds of things all make a DFL program work faster. So then you get the people that say, well, I've only got one debt and it's a mortgage. I've heard that debt-free life won't work for you if you only have one debt and it's a mortgage. Absolutely not true. Okay. So what I tell you, and this is when I do that, a DFL program will help you eliminate your debt 15 to 27 years faster. That 15-year mark, that's if you have a 30-year mortgage and that's the only debt you have. It will cut your mortgage in half. Worst case scenario. And if you do what I'm getting ready to show you right now, mortgage chunking, it'll do better than that. So here's where we go. Mortgage chunking. We're going to make some assumptions. This particular client had a $215,000 30-year primary residence mortgage. If you remember, I told you that all those debts were paid off, and the only debts that they had left after all the little debts were paid, the cars and the credit cards and all that other stuff, was the evil student loan and the 2 houses, right? Okay. That happened in year 2.3. That is the norm for these programs. If you've got someone with 7 debts, they're going to eliminate almost all their debts with the exception of their largest debt in about 2.3 years. That's when the debt snowballs really, really gets rolling. And at the end of that, then I'm going to assume that the standard debt load, which is we're looking at somewhere around $300,000, is going to be what the client started with. And I'm going to assume that that debt snowball allows them to purchase about $10,000 of PUAs per year, which is $833 of PUA per month. That's not that much. Most programs that I write are somewhere between $600 and $1,500 a month. Okay. So first thing we have to do is you have to look at a standard amortization schedule. This is that client. If you remember that, the illustration I did before, this is the same client. This is that first mortgage balance, $214,712. Okay. That's on day 1 of the program. Day 1. When we go 2.3 years in the future, we've got all those other little debts paid off. We've got a fairly sizable debt snowball that started. We're buying $833 a month of PUA. So we're going to advance. May 2023. That's 2.3 years in the future. At that point, just through them making their normal mortgage payments, the note that they owe is $203,000 of principal. Okay. So now I've gotten rid of all those little debts. I'm paying $833 a month. which is creating a $10,000 per year amount of PUAs that I'm able to use. 10,000 a year. That means once a year, I'm going to pull $10,000 out. So I'm going to go in advance. I just paid my single $10,000 payment. I went from 203,000, see it, to 193,000. What did I do? I went from March 2023 on my amortization schedule in one payment, to September of 2025. I advanced 2.5 years in my amortization schedule in one $10,000 payment. Now, if I took that $10,000, put it in the bank and made a payment every month, like my normal payment would pay, then it's going to be about 1/3, maybe 1/4 of what I did. It's not going to pay even a full years of payments. But I just escalated my payments 2.5 years into the future with one $10,000 payment. Did I use my money, Brett Desario? No, I took a loan. Am I still making my payments into my DFL program? Absolutely. What's happening with the money? Well, my money in my DFL program is going up and down and up and down. My loan capacity is going up as I'm making premium payments. My loan capacity goes down as I take loans. That's all that's happening. I'm dollar cycling. That's what we call it. When we cycle through our dollars over and over and over, that's what I'm doing. I'm dollar cycling. I used my $10,000. Not only did I use it once, but I use it every year. So I just escalated my mortgage 2.5 years in the future. And then what happens? I do it again. And then I do it again. And then I do it again. The end result is going to be that I'm going to escalate 16.5% faster through my amortization schedule than I would just using my normal. So this program that I outlined for these folks was 7.8 years. If the only thing they had was the loan for $215,000, if that's the only debt they had that I was running through this DFL program, then the DFL program, without tweaking at all, would have brought it, that 30-year mortgage, down to 15-year mortgage. And then the mortgage chunking. Okay, I'm gonna shut up for a minute, see if you got any questions. Anybody get that? Mortgage chunking, it's a beautiful thing. I just gave you more on it than Larry McLean charged you $500 to get on it. Okay, is one carrier better than another if you want to have a lump sum payment for the PUA?
Like, say if you just want to, you can, because my understanding is you can overfund it each month, right? But can you also just say, I don't want to be in the stock market anymore. I just want to put it in something safe, secure, or whatever,
Right.
or take it out of a, I don't know, I guess 401k.
Right.
Can't
So
really.
my knee-jerk reaction to that question is absolutely. But the reason why is not what you're thinking, probably. The reason why I would say that is because if you're going to overfund a DFL and it's going to be early in the process, there's one company that's going to give you monthly compounded rates. But there's only one. So the company that offers monthly compounding is going to perform better. If I put $10,000 in something that's compounded monthly versus $10,000 in something that's compounded once annually, the $10,000 monthly compound, even though they're both going to have the same guarantee of 4% or 3.75 or whatever, just the way the math works, the compound of the compound of the compound of the compound is going to be bigger on the 12 compounds than it is on the one compound.
Okay.
Okay. So there is a benefit. Also, the one company that I think of that I like to use, and I'm not trying to advertise for anybody here, but the one company that I use for that, when you run the illustrations side by side, the one that does that performs 2.4% better. And that has everything to do with the minimum size of the death benefit for the whole life piece. Okay, because the minimum size is 80% less for that company than it is for the other two, which means the cost of insurance is lower and you can spend more money on PUA.
So is that
Right.
mutual?
So again,
Is that mutual?
I'm not advertising for anybody here.
Okay.
All right. Should you
I think I
combine a
know.
DFL with a biweekly mortgage payment? Absolutely. Sure. Right. Okay. Can someone have more than one DFL bank? Yep, absolutely. I have a flipper, a house flipper who has 12 at this point. He creates a private bank for every house that he flips. Cannot put a DFL policy on a child. Got to
At
be
least
18 years
18?
old. What?
That's what I'm saying. At least 18, is that the youngest?
Yeah, because the PUA rider, you can't get a PUA rider on someone who's not at the age of majority. Okay. Is the amount of the policy tied to the household income? Well, no. The amount of the size of the policy depends. There's a lot of factors that go in. How much debt, what the income level is, what the financial goals are for the client, what the other retirement pieces they have in place. All this stuff. There's no one size fits all. Right. And everybody, there's a lot of questions to ask, and you got to do a deep dive into these programs for people. So there's, I can't really answer that question. Certainly the household income is going to determine how much money they can afford to put into one of these programs. All right. All right. The next one I'm going to do is, this is for you, Linda Chung. I think the last time I shared this one, I got a 4-letter word out of you.
Oh.
Oh.
There's a couple of different 4-letter words I like, but I don't know which one.
Right. All right. Hold on one second.
Do all of them require, I had a quick question. Do all of them require, like, is there some minimum? I thought well, I don't know, you don't want to say, but some of them, they lowered the amount of the underwriting. That's the part I always get stuck with, and I don't know, have a limitation that don't require the blood work and stuff. Like,
So
that's what one of them said.
all the carriers have gone to an accelerated underwriting for smaller programs for younger, healthier people. And the ages between the ages of 18 and 50 is the first prerequisite, and under $1 million of 10-year death benefit is the second requirement. So when you're tweaking these, you can tweak it within the term and the whole life piece. You can put less term and more whole life, keep the premium the same, and that's going to still keep your PUA amount fairly high. And that's the way that you can tweak them so that you can get them under that 99,999 number. So it can be it's not simplified issue, it's just accelerated underwriting. The general rule of thumb is, though, this: if the client has anything wrong with them health-wise, they're still going to order a paramed, first off. And if the client hasn't been seen by a physician within 2 years, they're still going to order, because they're going to have verify that they've been seen by a physician. Okay, so those are the two pieces that I see, even though I spend my time trying to tweak it so that it can get in under that bar, but it still ends up being fully underwritten.
Okay.
All right, we got a few more minutes. So this is the last one I'm going to show you. This is the one that I got a reaction from Linda Chung the first time I showed her. This is a special one. It has a special place in my heart. All right, Linda, let's see if you can remember this one. Look familiar?
No.
No? Okay. All right.
Piles of money?
Yeah, piles of money. Right on, baby.
Shit. Okay.
All right. So what is this? So this is a distribution phase. So the mortgage chunking, that was a maximization phase advanced concept. Okay. The escrow funding, that was both a maximization phase and an accumulation phase strategy. Because after your debt's gone, you're still going to be paying your homeowners insurance and your property taxes, right? So that's going to happen even during the accumulation phase. This is specifically just a method to maximize the distribution phase. Okay, so here's how this works. Remember mortgage chunking? When we looked at mortgage chunking, we were looking at, okay, and I used $10,000 as an example. So this is supposed to fall in line with that $10,000 mortgage chunk example. Okay. Once you get those programs built up and they're streamlined and they're really, really producing, you're going to be able to take a regular chunk of money out of that program. If you did the mortgage chunking strategy, then you're already accustomed to taking those loans, accustomed to dragging $10,000 out at a time and throwing it at your mortgage. Okay. If your program is large enough, you can do one of these. This is an annuity stack. Okay. So here's how this works.
Oh, now I remember. Got it.
Yeah. You gave me a 4-letter word last time.
Yeah. Now I remember.
Yeah. All right. So the idea with this is I'm going to continue that strategy even after I've completed my maximization phase, but I'm going to pretend, I'm going to put the blinders on, and I'm going to pretend that I'm still in the maximization phase. And I'm going to pretend that I still have another $120,000 debt that I have to pay off. And the way I pay it off is by paying a $10,000 payment every quarter. Where do I get the money from, Brett Cesario? I take it right out of my DFL. So what am I doing? Am I taking my money out of the DFL? No, I'm taking a loan. So do I have my $10,000 in my DFL when I do this? I haven't taken it, still there, right? Still earning my guaranteed interest rate plus the dividend, right? Still rolling. And now I take $10,000 out. Here's the critical part. If you've ever done an annuity application, they're going to ask you some questions. The questions are, is the money borrowed? Where's the money coming from? So that means when you do this, there has to be a plausible reason where the money is, right? Otherwise, it's money laundering and you're going to jail. I'm not going to jail. Okay. So what does that mean? That means, okay, I make $10,000 a month and I'm going to take $10,000 this month. And instead of me using the $10,000 that I made this month to pay my bills, I'm going to take that $10,000 and I'm going to buy an annuity. And then I'm going to borrow $10,000 from my DFL to pay my bills this month. Okay. So you have to be able to say that. And you have to be able to prove it. There has to be a money trail. There has to be a paper trail. Okay. They're probably never going to look at it. They're probably never going to question it, but just do it the right way. Don't put yourself in a position to get in trouble. It's not worth it. Okay. So I see Linda, Counselor Chung is giving us the go ahead, right?
Yes.
Okay. So I'm pulling $10,000 out of my DFL. I'm putting it into my checking account. I'm letting it season. How long? I don't know, 3 days, 5 days, 10 days, whatever. It doesn't matter. Okay. And then I'm taking $10,000 out of my checking account and I'm buying a $10,000 annuity. So what I've done in essence is I've taken the same $10,000 and I have it in two places at the same time. I have it earning my 4% plus a dividend over here in my DFL, and I have it earning 8% over here in my annuity. I'm also getting my bonus with my annuity. This is a real number run on a real individual. I use the Athene Performance Elite 15. That means that I'm getting a 9% bonus on day one rollover. Can anybody say hallelujah? 9% just for moving your money from A to B. Pay me, okay? 9%. That also means that I'm getting my interest rate. The average interest rate that we're illustrating here for growth with this Performance Elite 15 is only 6.2%. The actual interest rate on this is 8.7. I'm not showing the actual number. I'm showing the conservative number. The Performance Elite 15 is superior, okay? At least at the time that I did this illustration, it was. So in that point, I'm taking $10,000 a year every year. I've taken my $120,000 debt that I added into my program, and I've turned that $120,000 debt into $280,000 of value. Can I get a hallelujah, please? Or a holy cow? Holy cow works fine. Now, more importantly, this is great, right? More importantly, I also created for myself $13,944 a year of additional income on top of what I'm getting from my DFL. Where's my money, Brett Cesario? Still in my DFL, right? No, now it's in my DFL and in my annuity. Same dollar.
It's in my pocket. That's where it's at, in my pocket.
All right. So Counselor Chung, what do you got for us? You got any questions?
Yeah, so that's a draw then, and that's taxable though, right? So it's not like.
It is. Yep.
Okay. And can you do this with the same thing with, like, what is it, qualified annuities?
You cannot, because you can't have a qualified money get in. Well, I guess you could. You could start one of these DFL programs with qualified money, but this is, don't forget, by default, the money that you're using here is post-tax. So this is not just a standard annuity. This is a Roth annuity. Okay. So yes, it's taxable. It's just not taxable at the same rates that you're normally paying on a traditional annuity. Okay. And more importantly, there's no limitations on when you can touch it, other than the surrender fees if you touch it too soon.
Okay. Other than year 16, right?
Yep. So in year 16, your gain is 245.33%. If you don't touch it for a couple more years, let it run to the 20th year, your gain is 303%.
So who would this be a good fit for, this like combo thing?
Anybody who's got a larger DFL that wants to really soup up their retirement and wants to retire early. Because here's the trick. If you noticed, I'm very specific with the months that you start these programs. Okay. That's because I'm trying to create an income stream. I don't want my income stream to be $13,944 once a year. What I'm trying to do is I'm trying to give myself an additional income stream. So by staggering these quarter by quarter and month by month within the quarter, then I'm creating maturity dates that are going to happen one after the other, after the other, after the other. So I'm going to be able to touch this on a regular basis. Just through growth.
And there's, I guess these are individual annuities, right?
Yep,
Just
this is
$10,000
individual.
annuity.
This is 12 individual $10,000 annuities.
And I remember now, it's like, this is a way to make the DFL cash flow, essentially,
Well, I mean,
with the combination of the annuity.
right. You're making the DFL be the funding source for the annuity. Okay, but you're not limiting the DFL's performance. You're keeping the performance.
You're getting that plus
Right.
this.
Yeah. So, there's some people that I've talked to and shown this to, well, why can't I do it again? Well, there's nothing that says you can't. You can take it if you're accustomed to this. This is a 3-year program. If you're accustomed to pulling $40,000 a year out of your DFL and putting $40,000 a year into your DFL, then you're going to be cycling through those dollars. You're going to be paying back the dividend before they look at that, before they take that snapshot to determine how much of a dividend they're paying you. If you're taking the loans, there's another strategy we haven't talked about, which is how you take the loans. There's a logical way that you would take a loan so that you're paying it back within a specific period of time, because one of the carriers gives you a refund on the interest they took up front if you pay it back within the year. That is huge. Okay, I take a $10,000 loan and I take 10 months to pay it off. I'm going to get 2/12 of the interest back. Okay, that means my net cost for that $10,000 loan is going to be 0. They're going to charge me 4.76% up front. They're going to credit me back 4% to 0.76 in the end. 4%, done. Zero net cost. Okay, what happens if I take it as 10 $1,000 loans? That means I'm still paying $1,000 a month. That means in month 1, I'm paying back the first loan. When I pay back the first loan in month 1, that means I'm getting credited back 11/12 of the interest they took up front. Month 2, I pay another one back, 10/12. Month 3, I pay another one back, 9/12, and so on. The end result is, one way, I've got 0 cost for the loan. $10,000 loan, pay it off within a year, pay $10,000 in PUA, pay off the loan. I'm going to get credit back 2/12 of interest. My net cost for that money is going to be 0. The other way, by taking it as 10 $1,000 loans, I'm paying back 6 of those before half the year's over. My net cost of money is not a cost. My net gain is 2.33%. That should have been a holy cow moment for you too. But that only works with one carrier, because there's only one carrier that does the monthly repayment of loan. So yes, I have a favorite carrier. Any idea why?
Okay.
Okay.
Yeah.
So that's daisy chain annuity stacking. That's where you get the money from. You derive it from your DFL. It's not something that you can do as a primary exit or primary distribution strategy. It's an adjunct strategy. Okay. And this is all these programs, all these advanced parts are not for the standard, $100, $150, $250, $500 a month person. These are advanced strategies. All right. So I'm going to shut up for a minute and see if anybody's got any questions. What age should this be best for? Anybody over the age of 18, under the age of 75? Can someone put their whole pay in a DFL program? How much they put into a DFL program is up to them. There's no right or wrong amount. It's just financially, it has to be able to be supported. I've had people that have said, well, look, I've got $3,000 a month in bills. I want to pay $3,000 a month into my program and pull out $3,000 a month of bills. That's a nice idea, But if they're not, if the underlying DFL, if the default DFL is not large enough to support the interest payment on that $3,000, the program will fail. You cannot use this as like you would a bank, like you would a checking account. You can do that with this, but there has, the primary bank, the primary funding strategy, primary funding source has to be large enough that the interest that you're going to get on that primary funding is enough that you're going to be able to pay those loans off in regular order. To do what I was just saying, pay it off quicker than 12 months. Okay. Is the process of withdrawing funds easier with one carrier than another? I haven't, I've had bad experiences with 2 carriers. I've had good experience with 1, but the truth is, and I'm just going to be honest and clear here, the population size that I'm drawing from is small. So I don't know that my experience is enough to torpedo one or the other. I will say we've got 3 carriers that do this. You only need 2 of them. You need 1 because they cover older folks up to age 75. And then of the other 2, pick 1. The one, in my opinion, is definitely better than the other. All right. Think. Do all carriers require medical exams? No. All of them have that. We already talked about that, right, Linda? Okay. Okay, I think that's it. Anybody else have any questions? Finished up a little early, that's awesome.
Scott.
Yes.
Hi, it's Roy Morgan.
Hey, Roy.
Hey, just a quick question. I had asked about putting it on the child if the parent doesn't qualify medically.
Mhm.
So I understand if the child's 18 or older.
Right.
If that happens and that need for the parent to have their own DFL bank, they have to have the policy on the child. Does that in any way disqualify the child from going and getting their own DFL bank as well on them?
No. However, there's still going to be, you're going to go through that standard underwriting financial state issue. Whereas, if I want $1.5 million on a child that's in college, why? Okay. So if I do the parent's DFL on the kid and I maximize the life insurance benefit, don't forget, it's still life insurance. You still have to go through those questions. If I use up all the potential life insurance that the child should have, then that can damage it. But don't forget, the parents, right?
Mm-hmm.
The child's the insured. Who's going to be the ultimate recipient of the program? Right? I mean,
Child.
in theory, it's going to be the child is going to be the contingent owner. If both parents die, what do they don't need the money for anything, right? So, that's a discussion to have with them. I will tell you this, I got a lead about 2.5 months ago for an 86-year-old gentleman. And I met with him in person because he wanted to meet in person. He happened to be the retired dean of the Howard University School of Medicine. And he had heard vaguely about this program. I explained it. He really wanted to do it. We wrote this on his son, who's down in Georgia, who's 55 years old. So I do these on children all the time, on the children of parents. It's not a problem. Okay. But you have to be able to get through that financial underwriting discussion of why do they need so much coverage. Okay. And so hopefully that means you have a relationship with the underwriter, the carrier, to be able to say, okay, this is a par whole life program. It's a debt-free life program. The amount of life insurance is incidental. It's because we're trying to eliminate debts. And they can flub it a little bit.
Just an additional question on with the 18-year-olds, because I had this and I didn't know, like when parents are doing it on their kids that are 18, does that get considered somehow for financial aid or anything like that?
No.
Okay. That's what I thought, but okay.
No, that's a strategy. That's almost an annuity strategy, an annuity is an asset, but when you convert the annuity income, it's not anymore. It's a great way to get around those tax issues and those income issues when you're trying to qualify for support. Okay.
Cool. Amazing.
Anybody else? All right, folks. Thank you everybody for coming. Hopefully you got something out of this. This will be posted up on YouTube in the next probably week or so. Feel free, check it out again. Thank you, everybody. Have a great night.
Thanks, Scott.
Thank you.
Thanks,
guys.
Scott.